Hello, good evening, everyone, and welcome to our webinar this evening on wealth creation and investing for the future. Hopefully, you're all in the right place, and you're going to join me for about 45 minutes this evening while we go through this webinar. And I just want to remind people, if you want to stay to the end, we will have a bit of discussion on what's on offer, and that will be right towards the end of the presentation. So let's jump in and get started. So before we talk too much about wealth creation, a little bit about myself to start with. So my name's Kristin Sutherland. I am a financial advisor, a strategist, and a coach. I aim to give clients financial confidence when I'm working with them and to help grow wealth and get to retirement ready. I've got 3 decades experience in personal property investing, and I'm actually a published author also in the retirement planning space. So that's a space really close to my heart. I'm an experienced retirement coach from both that financial and psychological well-being perspective. So not just about the money, but also about the psychological side as well. So hopefully I can add lots of value for you this evening as we go through and talk around wealth creation, and for a lot of people that is related to retirement as well. So bit of a disclaimer to start with. We'll get this out of the way, because although I would love to know you all personally, I do not. So this presentation is provided for information purposes only, and the content of the presentation is not intended as a substitute for financial advice. So let's jump in and see what we're going to cover this evening. We're going to look at how to harness your money personality and your tendencies, because it's really important that financial advice and a financial or wealth plan is really tailored to you. We're going to talk around what a wealth creation plan is and how to turn that into then financial security, because they're both linked. The actions that you can take today, so we'll talk a bit around that to start building wealth for tomorrow, and why wealth building is a long-term mindset. So this isn't about get rich quick, unfortunately. This wealth building is long-term. So to give me a bit of a feel for who's here this evening and what you're all currently doing, we are going to run a poll. And the question is, what do you currently invest in? So there's a few options here. If you can go down and just choose for me what you currently invest in, you can choose multiple options there, and it just gives me a feel for the people that we've got this evening in the presentation. I'll give you a minute or two, and then our producer is going to come and just show us some of those results so we get a bit of a feel for who's here this evening. All right. Another few seconds to see. Okay, let's have a look. So lovely to see so many of you in KiwiSaver, which is excellent. Oh, quite a lot of people. So our next biggest group, we've got shares, we've got investment properties, 38%, managed funds, term deposits, high interest savings, and none of you have no investments. That's why you're here on a weekday night learning about a wealth plan. So that's excellent. And then New Zealand Super. Okay, great. So good to know who we've got here this evening. So I think a lot of the things we're talking about will appeal to a lot of you. And you might know some of it, but just listening, because hopefully there's always one nugget from these things that you get that you can take away. So if you're already investing, well done. And we can look at what other investment options are open to you. All right, so why should we prioritize wealth? So wealth really is about giving us options and flexibility. So it's not about the money, it's about giving us that flexibility to do the things that we want to, creating options for our life, how we want to do it. It gives us security, reduces stress, and helps us to be prepared, because we never know what's going to happen. We can't control it, but having some wealth behind us helps to just reduce stress in those times when those things do happen. It can solve some financial challenges easily. So if we've got a bit of wealth behind us, then, solving those challenges when they do pop up, and they will, because that's life, it helps us to solve those. And it can give us options like supporting family, leaving a legacy, and just dreaming, so that we can be a bit ambitious and say, this is what I want to do, because we only get one life, so let's make it a good one. So that's why we want to prioritize wealth. Let's have a look at how people feel about wealth in New Zealand. So, too often, I think, too, people confuse wealth and greed. So, we're not talking about being greedy. We're talking about building a base for yourself to give you options. So, we're talking about wealth in a positive sense, not in the sense of when we confuse that with greed. So, interesting statistics here 44% of people in New Zealand feel ready for retirement. So, that means most of you are not feeling ready for retirement. 54% worry about money weekly. That's just adding to our stress level. So if we can focus on a wealth plan, hopefully we can reduce those levels of stress so that we're not worrying about money weekly. And 70% of New Zealanders plan to work past retirement. Now, that's not giving potentially the options that you want. If you want to do that, great. If that's what brings you purpose and joy, then that's excellent. But we're talking about people having to do that not by choice. So if we can grow wealth, we'll have less stress, more choice, and ultimately a better future. And growing wealth, from my point of view, it isn't a luxury, it's a necessity if we want to have peace of mind and choices. So that's why we're focusing, and that's why you're here to look at why we should grow wealth. Let's look at some of the wealth misconceptions that are out there. So most people look for, when they're coming along to a financial advisor, and you might be the same, is you look for a single solution without realizing that we actually need strategic sequencing of how we build wealth. So one of those, really popular misconceptions is there is a single solution. So there isn't. We need a plan. So here at Enable Me, we don't just look at property or funds or KiwiSaver or any of the other investments we'll talk around. We look at every part of your finances when we're doing a wealth plan and help you to get that sequencing right so that you can achieve your goals as fast as possible. So anyone can build wealth. It's not just the rich. It's about how much surplus you have at the end of the day and what you do with it. You can start small, so it doesn't take a lot of money to get started. And investing is about being smart. It's not luck. You're not lucky because you invested. It was about having a plan and it being smart. And the right advice beats a finance degree. And it's interesting because I've had a number of clients who might be accountants or even economists, and they aren't actually making the right choices for themselves. So just because you might have the knowledge, sometimes it doesn't mean that you're going to make those right decisions. So having that wealth plan beats all of that knowledge that you could have. Now, the wealth plan also helps us deal with uncertainty. So a financial plan helps you prepare, remember, for the volatility, because things are going to happen, life happens. And it helps you stay the course when things get difficult. So whether it's paying down your mortgage, building wealth, or planning for retirement, the uncertainty isn't just in the climate, but in what your next move might be, where that might take you, and what it might lock or unlock or lock you out of. So we want to be able to deal with uncertainty well, and that's what our wealth plan is going to help us do. That's why it's important. So for the start, when we start working with clients, we start really at strengthening your financial foundations. So those foundations are the blue line along the bottom there. I'm going to talk briefly about a few of these. So your money habits are really important. So when people say, I can't do it because I don't earn enough, it's not about what you earn in terms of having a wealth plan. It's about what you do with what you earn, how much you spend, and then how you invest if there's any left over. But that might be adapting your money habits or your lifestyle. So that's part of our foundational level. It's about goal setting. So unless we have a goal and know where we're going, how are we going to get there? And how are we going to know if we are there? So I have worked with clients as well that actually are at their goal. They just haven't realized because they've been so focused on the getting there that they forgot to, enjoy the moment when they did get there. So goal setting and knowing when we're getting there is really important. Cash flow management, so how many money comes in, how it goes out, what you do with it in terms of your account structure, really important for firstly you feeling in control of your money and just knowing where it is and where it's going. Debt management, really important. So that's around, do we have short-term debt? Are we paying highest interest debt first? Do we know what levels of debt we've got? Are we limiting ourselves if we know our money personality doesn't deal well with access to short-term debt? So that level of management of having, our debt under control and knowing what it is really important. Mortgage management, we'll dig into this a bit further, has to be part of our wealth plan, because for a lot of people, their home is their biggest investment, and we need to make sure we're managing that as well as possible. And then adding on top of that, our insurances. Do we have them? Are they appropriate? Do we need less? Do we need more for our situation? That's part of our foundation. And then KiwiSaver. So the majority of people tonight, 91%, which was excellent, are in KiwiSaver. So is it working as hard as it could? Like, we want to make sure all of these financial foundations on our blue layer there are helping to build a strong base that helps wealth creation and long-term planning. Other things that affect how we function in this financial foundation is our money personality. So money personality really influences our financial decisions. Our risk tolerance affects how we build wealth. So the level of risk you're willing to take will affect what sort of investments you'll do, and then what sort of return we get. We have to balance risk and security, and that's key to progress. We don't want too much risk. But if we've got a really big retirement gap or a really big savings gap we're trying to address, we might need to take a bit more risk to get to the end goal that we're trying to achieve. But we need to be aware of our habits and then make smarter decisions around that. So when we're working with clients, we actually look at their money personality, because it's really important to developing a wealth plan for us to know, are you inherently, and this is how we're energized by money, a shopper, a saver? Well, there's a middle ground, which is a plotter, and they're not particularly energized by either at the end of that spectrum. But setting the wealth plan, you should take into account, what is your natural money tendency? You've got it from all different influences in your life, your family, your friends, all different places. So what is it? And then set your goals based on that. So a shopper needs a pretty attractive goal to make it worthwhile for them, whereas a saver might need a goal so that they can spend and enjoy the money. So we really have to adapt to that. And then your approach to risk is really important as well. So are you a safety warden where you might not take enough risk and we might have problems with actually getting the return you need? You might be an adventurer, or you might be a dreamer. So sometimes our dreams need a bit of structure and plan around them. So taking that into account is really important when we're putting together a wealth plan. So think for yourself around, what am I, and have I taken that into account when I'm doing my planning for the future? Because you're going to act in those ways no matter what. So we really want to make sure the plan adapts and suits you. All right, let's start at the beginning. So your starting point. For the wealth plan, we want to look at your cash flow management. So remember, I talked around what's your account structure? Where does your, if you're working, where does your salary go to? How does it flow between accounts? Do things go into debit when they shouldn't? How have you got that set up so that it works for you? What about debt? Because we know that debt slows wealth growth. So short-term debt, do we have mortgage debt? Do we have savings? Have you got a repayment plan for the mortgage? Or have we just done exactly what the bank wants us to do? Because that's not always necessarily the right way to do it. And have you set goals, and how are you tracking progress against those goals? So that's something you can do today. Set a goal, track your progress of what you're trying to achieve, and then knowing your money habits. So really important to overlay that. Don't set goals that you're not going to do because it's not interesting enough for you. We really need to overlay our money habits on that so that we can get them to help us achieve. So sometimes progress really does start with an independent, objective look at where you're starting from. So if you're not able to do it, get someone else, a financial advisor, a friend that you trust, whatever it is, get someone else to give us this independent, objective look of where you're starting from. It's very hard when you're in it sometimes to really be quite objective about it. Now, in terms of a wealth plan, some of this, it doesn't sound like a risk, but there's actually risks to leaving our money in the bank. So inflation is the silent thief of savings. So interest won't grow us wealth. So we really need to invest if we want to be improving our wealth position long term as much as possible, because investing beats stagnation. So stagnation is when, our money is effectively going backwards because we're not keeping up with inflation. So to outpace inflation at 3% year on year, if we had $100,000, in 20 years, that would need to have grown to $180,000 just to have the same buying power that it has today. So the risk of leaving money in the bank or in places that aren't growing enough for our wealth plan is that it really is this silent thief of savings, inflation. Okay, so what is a wealth plan? A wealth plan brings together for us the asset classes and a hold or sell strategy that provides cash flow to meet our financial goals. That's lots of words, I know, but it's about what sort of mix of assets and strategy we need. We need it to be tailored to your goals and timelines. We need to know your financial habits and your behavioral tendencies. And then we're maximizing what we've got. So we are all dealt a hand and we start from where we are. So I always get lots of questions on webinars or clients about, but I'm here, what do I do now? We all start from where we are and we have to maximize what we've got. So that's key to a wealth plan is we're starting here. Where are we trying to get to? What do we need to do to get there? All right. Now, sometimes through this wealth plan and with the number of clients that we work with, we see this quite often that getting rid of the mortgage of an owner-occupied home as quickly as possible is the first goal. So I'm going to show an example in the next few slides that explains why that is important. But on the same hand, I also don't want people to think that they have to be completely mortgage free to be able to grow wealth further. So we don't need to totally pay the mortgage off sometimes while we go about growing wealth. But if we have an option, oh, I've got this or this to do with my money, getting rid of that mortgage is our first course of action. It opens up opportunities for us and gives us more time to grow wealth the faster we get rid of that mortgage. So let's have a look at an example of that. So the impact of paying off the mortgage faster. In this scenario, we'll see that we've got a mortgage until 65. So the blue line underneath is this standard mortgage that the bank loves to give us, 30-year mortgage. So we buy our house at say 35 and we've got this 30-year mortgage at 65, we're mortgage free. In this scenario, we've got KiwiSaver kicking in at 65. So we get access to KiwiSaver, so we get a big boost in the amount of money because our black line that goes horizontally across, that is our 0 point. So we've got no debt at that point, but we don't have any money till our KiwiSaver kicks in. Then we use our KiwiSaver to live the life we want to. So this is about living a life that you want to, but in this scenario, that lasts until age 69. Then at that point, if this was a client of ours, we'd be saying at that point, you'll need to change your lifestyle quite dramatically, probably, to live within New Zealand Super. So it's about giving yourself the opportunity or the runway to grow wealth and close the gap that we called it. So in this scenario, we've got it at age 69, we're running out of money. But we really want you to be able to live the life you want to until 90. Now, none of us know how long we're going to live, but that's what we call a retirement gap. If we haven't got enough money to live until 90, we've got a gap. Now, in this scenario, if we could pay that mortgage back quicker, then we would give ourselves more time to build more funds. So in this scenario, KiwiSaver alone may not last that long. So paying it off faster, the mortgage gives us more financial freedom. And you might think I'm crazy by saying we pay it off faster because you're paying off as much as you can, but there's ways that we can structure mortgages about this mortgage management that gives us opportunity to be able to do that. So let's look at a scenario when we do pay that back faster. So in this scenario, we've now shortened this mortgage by 10 years. So we're mortgage free by 55, which means we've got 10 extra years to invest. So in that time, that's our wealth creation period. So you'll see here, we go from 55 to 65, and we've got that darker green line that takes us up to a point that then our KiwiSaver kicks in. And then our wealth lasts until age 80. So remember last time we were 69, now we're 80. So it's just giving us more time to build some assets. And so the wealth plan, in this case, it's about options, but it extends that security into later life. And it might be that, if we stretch those savings a bit further, that we could get to 90. So it's just about doing all of this planning as early as possible, but it's never too late. So I know I always get lots of questions of, is it too late? It's never too late to start planning. We can always improve where you're going to end up if you start now. If you don't start now, it's not going to get better. So we want to start today and improve as much as we can to help with this wealth plan. All right, so what about goal setting and planning? We basically need to know how much we need, how long it's going to last, how long it needs to last, and your level of risk. And setting a goal really does keep us motivated. So having the goal, knowing what it is we want, keeps us motivated to get there. We need to align that plan with your natural tendencies. So that was around our money personalities and our level of risk that we're comfortable with. Otherwise, it's not going to work. I just see too many people come along who have tried, but they haven't thought about how they naturally behave around money or what their approach to risk is. And they've tried to do a plan that doesn't fit their natural tendencies. And if there's someone else that's involved in your plan, be that a partner or parents or children, having those conversations early with that person that's making decisions with you is really important, and making sure it aligns with your goals, because we don't want you both heading in different directions, because then we're probably going to slow each other down. So have those conversations. They can be awkward, but they're worth having. So what are our options for wealth creation? There's a number of things, and in that poll, we did have a good spread of people doing that. So we've got bonds, managed funds. We could invest in gold or collectibles or digital currencies. We might look at ETFs, so that's into shares again, index funds, forestry, term deposits, property, and business. So lots of options there, many ways to invest. Not all of these are going to suit your situation. So these will all come with a inherent level of risk to them. So we just need to know where are you now? What's your gap to getting to where you want to be? We're going to know that by your goal, and then what's going on at the moment. Then what level of risk do we need to take to get you there? So your strategy should balance risk and your long-term goals. So let's have a little look at the level of risk we have with each of these wealth options. So risk and return go hand in hand. Generally, the safer the options yield our lower returns. So on this graph, you can see we've got risk and return going up the side of the pages. And at the bottom there, the lowest risk but the lowest return, we've got cash. And if we work our way up that line, then we get to term deposits, managed funds, property, shares, and business. So cash is stable, but it won't grow your wealth. And the problem with cash alone is inflation. Business is high risk, but it's high reward. So if you have a savings gap and it's quite large, then we might need some higher returns, but it also means we're going to have a bit higher risk. So a well-planned strategy, or our wealth plan, balances risk, returns, and your financial needs. So we need all of these things to be balanced for you. So if you know you've got a big gap, you might need to be looking at things like property, shares, or business to close that gap, acknowledging that there is going to be high risk with those, but that we've got the opportunity for higher return. So knowing where you are, where we're trying to get to, is really important. Now, I get asked a lot actually by clients, is KiwiSaver still worth it? So we've had a lot of changes in legislation on this, but KiwiSaver is still a great foundation, but it's not a complete retirement plan. So the employer, so our employer's still doing contributions, and that has just raised in April this year to 3.5%. And then we've got government contributions. I know that they're smaller, but actually that little bit still makes a difference if we compound that over time. They do make it highly beneficial to be in KiwiSaver. Many people assume that's going to be enough for their entire retirement plan, but for most, there's a bit of a shortfall. So we need to be thinking of things outside of KiwiSaver if our lifestyle is bigger than the amount that we're going to be able to provide ourselves from KiwiSaver. We also need to regularly review our KiwiSaver and ensuring that it's tracking for our goals. So we might not know the number we need to get to yet to live the lifestyle we want, but finding out that number is important, and then looking, is our KiwiSaver on track to get us to that number? And if you plan to retire before retirement age, so before we're going to get New Zealand Super, please look at investments outside of KiwiSaver, because we can only access that at 65. So we need to be looking at things, because these funds in KiwiSaver are locked up until we're 65. Apart from a few scenarios, most of them we don't want to be in because it might be health related, or first home. All right, let's have a look at the pros and cons of some of these different asset classes that we've been talking about, and then options for our wealth plan. So pros and cons of term deposits. So term deposits do offer us safety and predictability, but they come with their trade-offs. So they're good for stability, but they're not good for high growth. If we're looking at term deposits and short-term savings accounts, inflation is the most important consideration, because your returns might not keep pace. And we do want to beat inflation, otherwise we're going backwards with that investment. You need to think about your financial goals, and do term deposits fit the overall strategy? So for some people they might, but you need to look at it. For me, looking at these pros and cons of term deposits or short-term saving, do they fit the strategy that is appropriate for me? How about managed funds? So pros and cons of managed funds. So managed funds allows us some diversification and professional management, but the fees can impact return. So it's a trade-off that we're getting this diversification and management, but we've got fees now. There's a range of options in managed funds. We can go from conservative, where it's the lowest risk, to aggressive, where it's the highest risk. And this is to suit different investors. So that's a great option in our managed funds. It's really important to balance risk and reward. So the higher the returns, they come with the greater ups and downs. So if you're a safety warden, remember, going back to our money personalities, you might not cope very well with an aggressive fund if you're going to look at it all the time, and it's going to worry you because it's going to go up and down. So balancing the risk and reward for you is important. And consider your investment timeline and the goals when choosing a fund. So generally, the more aggressive we go in a fund, the longer we want our funds to be in there, because we can weather the storm of the ups and downs. Like, there are going to be ups and downs if we go for a higher growth or aggressive fund. We never want to be in a position where we have to draw out those funds at the worst possible time. Say something's happened in the States, and funds are not doing as well as they were, or something's impacting them and it's a short-term thing, but we need to access that money. That has a negative long-term effect on our wealth plan. So consider your investment timelines and your goals when we're choosing a fund. What about property? So pros and cons of property. Property offers stability. It provides rental income. It has growth potential, but it's not as liquid as our other investments. And by that, I mean we can't sell it as quickly. There is a high entry cost to property, but it can be offset by leveraging home equity. So it makes it accessible. If you've got a home and you've got some equity built up in that home, then we can leverage off that for property. Due diligence is essential if we're going to do property. So choosing the right property that matches the returns and risks that you need it to is important. And consider financing options and your long-term strategy when investing in property. So property is not a short-term option. It really should be a long-term time frame. A note on property: if we've got a retirement gap that is bigger than 300,000, you are likely to have to leverage. So that means borrow money to bridge that gap. So if you're looking at a retirement gap that is quite a significant one, we probably do need to look at leverage to be able to close that gap and get you to where you need to be. So that's one thing to consider with property, because that gives us the power of leverage. Now, if we look at that power of leverage, if we say have 160,000 to invest. Now, it's not that property is magical and it has better returns than other things per se, but let's compare if we put our 160,000 into a managed fund and it grew at 5%, or we put our 160,000 into property and it grew at 5%. Now, the difference with property is that we can leverage that to buy an asset that's now worth 800,000. So the bank's going to loan us some money. There's going to be some costs associated with that. But it means our return is, instead of a $8,000 return that we get on 5% on our managed fund, we now have a $37,000 return on the same money that we're putting in over that yearly time frame. So leverage boosts our returns. The wealth building advantage of property is that we can leverage it. So using equity to fund more so that we can control more assets that can grow. And the rental income offsets costs. So we do have costs associated with property, but the rental income helps to offset those. And it tends to make it, over a period of time, a self-sustaining asset. So it should be looking after itself after a period of time, where we will probably need to do some topping up in the beginning. So that's a good insight into what leverage could do to help you with your wealth plan to grow that faster. Now, some common investing mistakes we see. Diversification matters, so avoid putting all your eggs in one basket. We don't want all your money in one asset class, because if something happens to that, then it's a higher risk that we're not spread across different asset classes. We need to make sure high interest debt is gone first, so don't invest while drowning in short-term liabilities. If we've got, credit card debt that we're paying high interest on, if we've got other debt that is costing us a lot, we shouldn't be investing before we pay that off. Our best return actually comes from paying back that short-term debt. So high interest debt comes first. Start sooner rather than later. So waiting too long, procrastination reduces our long-term gains. So I said, it doesn't matter where you are right now. The best time to start is today. Tomorrow would be worse. So starting today makes a difference to where we end up. So don't be the procrastinator. Take some action. And separate emotions from investing. So it doesn't matter how you feel about something, it's about the financial outcomes of it, not your personal preferences. So try, if you can't do it, get advice where someone can objectively look at that for you, to say, I'm going to separate out how I feel about something from the actual financial outcomes. So that's some common mistakes that we see in clients. Now, the best approach for you depends on many things. So I get asked all the time, what should I do? And I'm going to do that really annoying answer that says it depends. And it does, because it depends on what's your time frame from when you're going to retire early, need the money, wanting to be help family. What is it? What time frame is it that you're aiming for? What are your goals? So what are you trying to achieve? Because what you're trying to achieve is probably quite different to what I'm trying to achieve, and very different to what other people on this call are trying to achieve, no doubt. So just knowing what you're actually trying to achieve and have those goals written down, really important, so we know if we get there. Your risk appetite. So we've addressed about our different money personalities. We've addressed what we're trying to achieve. In terms of timeframes, do we need to be taking more risk because we're on a shorter time frame? Are we going to sleep at night if we take more risk? I say to people, it's often not worth it. If you're not going to sleep at night, don't do it. We're trying to improve life here, not make it worse. So knowing your appetite for risk is important, and your capacity for risk. So, are you willing to take that risk, and what would happen if it went wrong? And could you tolerate that loss within the time frame that you need to do it? So it's all about knowing our time frame, our goals, and our risks. We do have to be flexible. A wealth plan cannot be set in stone because things happen, and we know that life happens all the time and things change. So we do have to put in flexibility, but that's part of the point of a wealth plan, is building up options so that we do have flexibility. Your ability to access mortgage lending is an important one. So if you're not in a job where we can easily access mortgage, if you're getting towards the banks are the only one that can discriminate on age. So, unfortunately, banks do tend to do that. If we're getting towards an age where we're not going to have regular income, they might discriminate on that, but our ability to access mortgage lending is limited. So we need to make sure we're making the most of that when we can. Access to equity. So can you access funds? Do you have some equity built up in your home potentially that we can access to be able to grow wealth somewhere else? So that will be different for everyone. So that access to equity is important. And what's the goal? So what are you trying to achieve? What are we trying to get you to be able to do? Is it your legacy? Is it helping family? Is it giving to charity? Is it just making sure you have a really good retirement? What is it that you're trying to achieve? And be really clear on that goal so that you know, can I get there? What do I need to get there? What are the steps? And have I got there? So be clear on the wealth goal, and the wealth plan helps you to get there. Right, a summary of our key takeaways today. So, most people, as I said earlier, are looking for a single solution without realizing that they actually need strategic sequencing. So, that sequence is really important. So, start with the goal. Investing without a clear purpose can lead to poor choices. Understand the commitment. Some investments require more involvement than others. So, do you understand what that is? Time is key. Delaying action really does limit options. So, just know if we're going to delay it, we're limiting our options going forward. Risk is different for everyone. Align your investments with your personal comfort levels. And expert advice does save you time and money. So, a good guide can help avoid those common mistakes. So if you're not sure and you're not able to, discuss it with someone else and come up with a plan, then I would really suggest going and talking to someone who can objectively look at that for you. And that's what we do here at Enable Me as well. We have a great consultation, which is actually called a financial consultation. It is a 90-minute strategy session, and it's with a qualified advisor, such as myself or any of the other financial advisors or coaches. Now, we really sit down, we dig into what your actual finances are doing right now. So we look at assets, your income, your spending, we talk about money habits, about your mindset, about your goals. We really dig in there and just see what the full picture is. Within that session, we do identify inefficiencies. So we could have a look and say, well, look, based on what you've told us, this is where we think you should be, or this is what we think you should be able to achieve. So we might identify something that you haven't been able to identify yourself. It might be some wasteful spending. There might be insurances we don't need. The mortgage structure might not be appropriate, or just achieving the best result for you. So within that consultation, we can identify some of those inefficiencies, and we investigate how you're going in terms of your trajectory and your goals. So are you on track to achieve the things that we've talked about in the beginning, which are the goals? So as a thank you for coming along tonight, we will offer an offer to be able to get one of these financial consultations with ourselves. And at the moment, because you've been here this evening, if you do book a consultation with us, it will be $100. So all of that, it really is a fantastic meeting of 90 minutes. If you book it tonight, it's only $100. It will go back to $149 after if you don't do it tonight. So I would encourage you, if you haven't got someone to talk to, come and sit down with someone and spend 90 minutes and just identify where you're at. Are you on track to get where you're going? And if you don't know where you're going, come and talk around that. So clarity really is comforting. Action beats waiting. So book tonight and come along and have a chat to us. All right, and I think I finished in good time. So we've got a few minutes for questions. So I will just check with our producer if we've got any questions specifically that you'd like me to answer.
Yeah, there have been some really great questions submitted, so I'll go through some of them. The first question is someone who asked about protecting yourself for a relationship breakup. So they
Yes.
said, okay, I know I need to get an opting out agreement done, but are there other things I should do to protect myself?
Yeah, great question. So, yes, an opting out agreement really is the basis of that protection, but there's other things. So, having appropriate ownership structures for the things you own currently, so all things you're going to purchase. So, thinking about, is a trust an appropriate structure? Is it a company? What's the shareholding of those? Who's going to own your assets? Make sure you document your gifts and inheritances. So, if anything comes in, we want all that documented so we know where it's come from. Keep financial records. It is really important if there is a problem in a relationship, and we see it too often where there haven't been any records kept of who's doing what and who's paying for what and what's gone on in the past. That is important just to make sure you're protected. Review your insurances. So I know we've already said this, but if we're trying to protect ourselves in case of a relationship breakup, make sure you've got life cover or trauma cover, and it's not just the other party who has it, because if something happens and you're a bit older, when this relationship breakup might happen, it might be very hard for you to get those. So reviewing those early and having them in place is important. And then updating estate planning, things like wills, powers of attorney, making sure they're appropriate. They're really important things in case, just protecting ourselves from if the worst happens and the relationship does end.
Thanks. Another question we had was, most of the strategies are focused on dual incomes. What additional steps can a single person take to create wealth?
Yeah, good question. So making sure that we are creating a surplus. So it is even more important. I mean, it's important for everyone, but more important if it's just a single income, that our income is higher than our expenses. And so we get a surplus and we're investing it somewhere. So getting education or advice on that is even more important for single people. Protecting your income. So having some protections that might be income protection, life insurance, those things. Yeah, are really critical if we don't have two incomes there, so that if something happens and we don't have that single income coming in, then we've got some protections. You could consider property ownership pathways that are different to if we had two incomes. So that might be buying a smaller property, having a border, or you might want to rent somewhere that you actually want to live and then invest somewhere else because it's a cheaper way for you to get on the property ladder. But critically, it is having a financial plan. So, if you're not, if we haven't got the backup of another income, then just having that financial plan is even more important.
Another question we had, someone asked, is owning a house slash having a mortgage a good investment, considering the opportunity costs of putting the down payment in the share market?
Yeah, so as I showed in the example before, the mortgage and having an asset that is property, it is the power of leverage that works for us. So on your own home, that power of leverage still works. So yes, generally, I'd say for most people, the mortgage is a good investment because we are building wealth and equity within that investment. I know that we then can't go invest in the share market in that same instance, but we're leveraging that money. So we've got a bigger asset that's growing at the same rate for us, but it just allows us to get to the growth on the whole asset value, not just the amount that we invest.
Another question someone asked is, if my partner and I have different money personalities, what tools can we use to build wealth together, knowing we both have some red flag behaviors with money?
So having those structures in place is important for our cash flow management. So if we're a bit different money personalities, we need a bit more structure. And I work with couples all the time that, we seem to attract the opposite in this sense, that we just make sure our structures are in place so that we know where the money's coming in. We have a really good plan for how it's going to go out, where we're going to spend from. Have a good tracking system, so where the expenses are going. Because if we've got someone who's a shopper and someone who's a saver, that does create some tension. So just knowing what is being actually spent is really important. And then have a plan on how you're going to discuss that. So if we are tracking, are we going to sit down and have a weekly meeting about it? Are we, going to talk about it once a month? Are we going to go out for a wine and have a discussion? Well, how are you going to do that? So communication, really important. And it's often the things we don't want to talk about that are the really important things to talk about. But if you know where the money's coming in, where it's going out, that solves a lot of issues apart from you thinking they spend all their money on this. We don't know until we actually track it. So tracking, having a plan of how you're going to discuss that.
Right, and we've got last question. Do you have any advice for someone who has had a couple of major life hiccups and has less equity than they hoped for by age 50?
Yeah, so as I've said throughout the presentation, we start where we are. So if things have happened and we're starting from a different position than we hoped for, we're still starting from that position. So we have to adapt the plan from there. It might be that we're acknowledging that's a shorter runway than we thought we might have or that we wanted, but we start from where we are, and we may then need to take some higher risk approaches. But if we don't know where we're starting from or where we're trying to get to, then we don't know how much risk we're going to take. But there's no point looking backwards. We can only look forwards, take action from today. So, yes, we've got less equity than we were hoping for. What are we trying to achieve? Where are we trying to get to? And we make the plan from there. So, make a plan. It's really important.
Thank you so much, Kristen. That's all the time we have. Thank you for everyone for joining us. If you've got any more questions about what we do, please visit our website. Our contact information is on there. Give us a call or email us. I'll let you close off, Kristen.
Yeah, excellent. So thank you again for coming along. I hope you got great insights or at least one that you can take away. But please do come along if you want someone to just have that objective view for you. Those financial consultations really are excellent for $100. It's a great insight into your own situation from an objective point of view. So come along and we look forward to hopefully seeing you, but enjoy the rest of your evening.